Welcome back to another episode of Drilling It Down. This is your co-host, Wes Lyon, and with me in chair number 2 today is Tyler Rott. Ty, welcome to the show.
Thanks for having me. Always excited.
So this is going to be our first YouTube podcast.
That's exciting. I mean, we got this whole new setup, so it's going to look real nice.
If anyone has tips for lighting, let us know. We're on a little bit of a makeshift studio, but we've got some camera angles here, and we're working on it.
Yeah, I think it's going to look great.
Today we're here to talk about top myths of permanent life insurance. And today we're specifically going to talk about whole life. We might do a whole nother episode on universal index life, or is it index universal life? Which one?
I think I've seen it both ways. They like to make it as confusing as possible.
Yeah, I find it hilarious. Sometimes I'm on LinkedIn trying to find, hey, need some talent, try not to pay the recruiter. And I found this one guy where I don't know. Apparently he owns a company, but all he does is go to all the life insurance salespeople and just comments hilarious things underneath their whole life insurance sales. So it's at least a good laugh. And he's one of the only people I follow. So it gives me a good chuckle every time I pull it up. But we gathered our top 7 from him and a couple other sources we have here. So Tyler, what's your number 1 myth on permanent insurance?
I think the number 1 myth is that it's really a good investment. People think that it's the best way to prepare for retirement, to grow their net worth, and really it isn't. I think it's unfortunately due to the projections that are presented to them and how it's sold to them. Most of these doctors are getting their information from, unfortunately, their friends. One of their friends turned out to be an insurance broker. And so I think it's in the first day of training, they say, hey, do you have any lawyer friends, doctor friends? You should reach out to them, sell them some life insurance. They need it. So they reach out to their doctor friends. They say, look, whole life insurance is what you need. Little do they tell you that you sign up for whole life insurance, they get a nice fat commission check on it.
No, definitely. Now, you mentioned something in there, projections.
Mm-hmm.
Walk me through what you mean on the projections. And do you have any examples you can share? I mean, we've been seeing this lately, but I don't know for the viewers and listeners out there, they quite understand what the word projection means, because I don't think the insurance salespeople present it as a projection. From your experience, do they present a projection, or they present, here's what's going to happen?
They almost present it as a guarantee, and they kind of gloss over the word projection. And what I'm talking about here is, they'll give you a pamphlet of about 50 pages, and a few of these pages are going to have tables of projected premiums, insurance costs, and returns.
I think the word they use is illustration. We like the word projection because it makes a little bit more sense, but I think they call it an illustration if you're ever looking at one of these.
That's exactly right. It completely removes projection out of that picture. It's saying illustrate, this is what you're going to see. It's definitely they choose that language for a reason. But when it comes down to it, these illustrations are projections, and it's going to show you, what they want you to see, which is your premiums going in, the insurance costs going down, and your cash value going up to, where it should be at the end of the term. The issue there is these growth rates of the cash value, of the surrender value, of the death benefit are going up at, most of the time, unreasonable amounts. I saw a projection from one of my clients where they were getting it for 8% return year over year, and that's after fees. That's something you need to understand on this is all of these illustrations, the returns on this cash value is after fees. So to get an 8% return after fees, you need above 10%, above 15% really in some of these, high fee products. So it's just a lot of unreasonable returns. I even saw one was 12% after fees. So
yeah, that one we were looking at too. We couldn't back into the math on it because the illustration was showing 6% annualized, but we did the math and said, hey, if you just had 0 fees and made 6%, what would your money grow to? And we just couldn't figure it out. But then I want to step further, and this is very, very important to note for everyone, because the way a whole life insurance policy works, it's based off some index, and sometimes it can be the S&P 500, and it will have a cap on it. Now, they're guaranteeing a floor on the policy, right? They always say the policy is not going to go down. So putting a cap on the upside, okay, I totally get that. However, a lot of times they create indices. So one of them we were looking at, and it said,
Mhm.
hey, you're going to get 6% annualized. This is the actual performance of this index I'm recommending that you invest in over the last 25 years. And then we look, and that index was created by somebody 3 years ago. I mean, it's like, well, yeah, if we could go back in time and predict things 25 years ago, I would have told you to put all of your portfolio in Apple,
Yep.
right?
Netflix, Google, all Amazon.
I mean, and you just would have made a killing. But, you can't say, hey, look, after the fact, if we would have done X, Y, and Z, look how your policy would have performed. When in our world, they make us do something, not really the consulting world, but in the investment world, they make you do something that is, past performance is not guarantee, or is it?
Indicative.
It's not indicative of future results, to just basically tell you that, hey, this did this in the past. It has zero bearing on what this will do in the future. But they get a lot of people on these projections or illustrations. And then, Tyler, have you seen, if you dig in the back, I think they're required to show you the illustration with the minimum guaranteed value.
Yeah, and those come to around 1 to 2% when you back into the numbers there, and that's not the one that they harp on when they're selling you the product. They're saying, hey, you're going to get 8% return on your investment if you do this, but guarantee is only about 1%. So
No, so we haven't seen any of them perform. I mean, we've had people come in here that they put 1.4 million into them, and they're only worth 1.2 million. And then to make it worse, they owe taxes on the money. So that might get into our next myth, that these are a tax shelter. So Ty, what are they typically selling when they sell these things for tax wise? Is it?
So they say that you put in your money, you can get it out tax free. Little do they tell you that you're taking a loan against the policy. So that loan incurs interest, additional fees on the policy, reducing your dividends. Also, they don't tell you that should the policy not perform, should the policy terminate, all those loans that are tax free before are fully taxable at ordinary income.
At ordinary income rates.
Exactly. So you're paying 40% state, federal, even higher if you, depending upon where you live, what your income is.
And for the listeners out there, I think the comparison they're always making is this is tax free. And if you get into a brokerage account, it's not. However, most of our clients in retirement pay long-term capital gains at 15 to 20%. So you're potentially doubling the tax rate on the policy.
Yeah. And that's capital gains as well. You also have basis in your investments too. So, you're not paying full tax on your sale.
Now, you do get basis in the policies.
Yep.
However, I think what people don't realize is what's different. If you put the money into the S&P 500, you put $1 million in over 20 years, your basis is $1 million, right? Pretty plain and simple. Where people get tripped up is you put $1 million into a whole life policy. Well, they take all their fees out, all the cost of insurance, all of that comes out before they calculate your basis. So you put $1 million in, you might only have a tax basis of 600,000. So that's how you lose money and still pay tax.
Yeah, and that's even if your cash value is where it should be. Let's say you put in $1 million, your basis is about 900,000. Oh, little do you know, your cash value is about 950,000. You still end up paying tax on that difference there. It's
we were talking about this in the monthly, drilling it down too. Is okay, what's the likelihood? They're showing you all these things, but what's the likelihood that my policy doesn't perform? Pretty darn likely. In 1979, the government set out to do a study on how bad these policies were or good. And they found out that most policies only returned 1 to 2% annualized, and they're charging more than that on fees. I mean, it's a high likelihood you're going to end up getting smoked on one of these policies.
And I think part of that comes down to, insurance companies aren't any better investors than, low cost indexes, low cost mutual funds. In fact, they're worse investors, really. So you're paying these premiums, you're paying these fees for a product that really isn't going to return you what you could do on your own with, a Vanguard low cost full market ETF or mutual fund.
Now, that kind of brings me in, I'm going out of order here, but kind of brings me in, but in a whole life policy, Tyler, if I recall correctly, but this it gets a guaranteed amount to your kids.
A guaranteed amount, yes, in the form of a death benefit and cash value. Do you get both?
Oh no, there are gonna be some upset life insurance agents when they hear this. No, I don't think most people know that. Have you? We tell this to everybody that has one, and for those of you out there, don't feel bad. Almost every doctor gets swindled on one of these in their lifetime. So they usually come in as part of our tax and business planning program, and we have to go through it and tell them. And it's always we go through these things, and I think most people don't quite grasp. It's kind of like us trying to learn how to do a root canal.
Mhm.
Yeah, uh, don't know what you're talking about. Great, but I don't have the baseline, and I think a lot of people don't quite understand how impactful the fees can be, the cost of insurance, all the stuff we're talking about. But the second we tell them, by the way, do you know your kids are only going to get the death benefit and not the death benefit and the cash value? And that seems to throw everyone for a curveball.
Mhm.
If you have a $500,000 cash value and $1 million death benefit and you pass away, your kids get $1 million, not $1.5 million. So you don't receive both of them. The other thing is, you put $1 million into this thing and they perform according to the government study, which we don't have any more recent studies because there's no uniform requirements to report this performance, which is just insane. But the insurance companies spend a lot of money lobbying.
Yep.
So we don't have anything. I will tell you from our experience of seeing probably 5 of these a month on average. Those numbers from 1979 still hold true. They're about 1 to 2% performance wise on average. Now, the insurance companies will calculate performance however they like. I like to just look at, hey, they're selling it as an investment. They're not selling it as life insurance. So how much money did you put in? How much can you get out? That's very simple math. The study we actually referenced, though, that went a little bit further and said, what would the cost of insurance be in term? So let's take out the cost of insurance, and they still only get 1 to 2% on that. But okay, you've got this guaranteed amount. But if you just invested it and you made 6% over the long run instead of 2%, or let's say 7%, because I think the rule of 10, your money doubles every 7% doubles every 10 years.
Mm-hmm.
So at 2%, your money's going to double, I don't know, once in 40 years. And at 7%, it's going to double every 10 years. Your kids are going to have a whole lot more money, although not guaranteed. They're going to have a whole lot more money if you just don't get in bed with an insurance company.
Yeah. Or if you are in bed, you get term insurance, investment account on the side. Term insurance, we've mentioned it, is the best cost benefit for, the amount of insurance you receive for the premium cost there. There is fees associated with investing, your expense ratios and all that, but they are much, much lower than the insurance costs and the other fees associated with permanent life insurance.
Oh, absolutely. So most people, that kind of brings up a good point before we get to the next myth. What is whole life insurance, Tyler? Like, if you could describe it in very simple terms to somebody of, hey, what are you actually getting when you purchase this?
So simply think of a box. You got a cardboard box here that you're gonna, mail a package to somebody, and you're gonna fill it in with a few things that you want to ship to somebody. So first part of this whole life policy is the insurance. What that insurance is a term policy. So you take your term policy, you put that in the box. Next thing is we got this cash value. So how are we going to build up our cash value? We have an investment account. So we have our cash value, we have our investment account, we have our term insurance in our box. But if you shake that box around, those things move. So we can't ship it to our friends. Otherwise, it's going to get damaged. So what we got to do, we got to put all those little packing peanuts, those, plastic airbags. You know what those plastic airbags and packing peanuts are, Wes?
What?
Those are fees. So
Oh,
you
gosh.
shove enough fees in there, that investment product and that investment account, and that term policy don't move around. And that's again where all that return goes. All those fees take all that investment return away.
Yeah, I'd almost equate it to, let's say you've got like a box big enough to put a mattress in it, and there's just 2 shoe boxes in the box. And then the peanuts are the fees.
Yep.
So we have to load the whole thing up to not damage the rest and not have everyone figure out that actually inside this box are separate components. But no, that one right there, I always tell people it's just all those fees. It's going to get you. And the reason this gets sold, as you had mentioned before, is a lot of the times the sales charge on the front end can be, 40 to 100% of the first year premium. So they'll convince you to start this thing with $100,000, and they'll forget to mention to you that they're putting $50,000 in their own pocket for you buying this policy.
There's a huge financial incentive for insurance agents to sell you whole life, permanent life insurance over term. Term, you're not going to make as much.
Yeah. So another favorite one of mine, and sometimes I overlook this because we work in this world, so we know not to do it. But some people do get caught up. They see things on social media and infinite banking, or rich people do this, so you should do it too. I mean, Tyler, is that just a scam?
No, I mean, it's not. It's true. The ultra wealthy do take advantage of some of these strategies, but the reason they do it is they've taken advantage of all the other tax advantage strategies before this. They have so much money, they don't know what to do with it.
Now, I'm going to get an argument here with you.
Yeah.
I think that's incorrect.
Okay.
I think they do it because they've also been swindled.
Probably.
There's better ways to pass money, because I know in my first role, we were working with some pretty ultra high net worth people. Back when I wasn't solely dentistry, to try to protect, I won't say anything to give it away, but one was like an American dynasty family that we had. I mean, when this man rolled through the door, his security rolled through the door. His kids and grandkids would call me, but the man himself, absolutely not. He rolled right into the managing partner's office, didn't say hi to the front desk, security out the wazoo coming up. And I can guarantee you that man had 0 whole life insurance policies. We helped him solve his estate tax issue, and you really didn't need to get one. We had another one, famous musician, but not pop music, more of like classical stuff. And, you know, I don't think that pays that well. So I think she'd inherited the money. However, again, zero whole life insurance on this. So I haven't run into it with anybody ultra wealthy. I can name a few people off the top of my head that have gotten swindled into this that I think are in the $60 to $80 million range. And when they told me about it, immediately each time my first gut instinct went, there's an easier vehicle or a cheaper way you could have done this. But you know, you can't save them all. So
Yeah.
I tend to think that that's a little bit of a scam. I will admit that some wealthy people do it. I've met them. However, most of your ultra wealthy people aren't doing it. I'd even take that a step further. I had this question the other day. Somebody called me. It wasn't to do with life insurance. I think it was to do with running a commercial real estate conglomerate. And he asked, well, of the top doctors that you have or that you've seen that have really made it, you know, financially, what have they done? And I said, well, top of my head, I can name 5 or 10, and they've all done the same thing. Low cost investments, and they just saved a lot, and they've used the time value of money to their advantage. I don't think there's some secret out there for how people get wealthy. They just save more than they spend.
Get it auto drafted in, dollar cost average. No better way to do it, really. You spend, any excess goes into savings, and you just don't even think about it. It's the best way to grow your net worth.
Well, another myth I have here is it allows you to spend down other assets because you know your kids will get this. Is that true?
I mean, not really. Again, it's you're paying these premiums every month. That's bringing down your monthly cash flow. You're spending down your other assets. It's not the best thing. Again, they're only going to receive the death benefit. It's just a lot of these promises are really oversold. You know, if you need money in retirement, do you look for an annuity instead as a way to guarantee funds for you? It's not the best way. And if you're really looking to pass money down to your kids, there are better ways and other ways that to pass them down tax free.
I mean, you could always just, you know, make a gift of the premium each year instead of the premium, though, and get it in a brokerage account in their name and let it grow.
Absolutely.
I mean, there's lots of ways to do this that don't involve whole life insurance. Back in the day, this is my rule. I don't know if you've ever heard the story of why I have this rule. But I will not talk to your financial advisor. I will talk to your CPA if we're working together. I will not talk to your financial advisor. made this mistake. This guy had shown one of these illustrations, and my client was thought she was set to retire, had put like $115,000 into a whole life insurance policy, and he had some illustration where this 115 turned into $10,000 a month, which was absurd. So he wanted to have a call with me. And the first thing out of his mouth, and this client thought she was going to retire and she wasn't. And we had to go in there and redo everything. And she had to work for another 4 or 5 years. I mean, it was ugly. Fortunately, we were able to fix it and she got out on time, but she wasn't even close to retirement when she came to see us. I mean, I think she had a net worth of like $700,000. Like it didn't take a genius to figure out this wasn't going to work. But first thing he says was, well, have you even thought about her legacy planning goals? I sat there, I started yelling at him. I'm like, who cares about legacy planning? She doesn't have enough money for herself. I don't care about her kids. Like, if we can solve enough money for herself, we'll care about her kids secondary. And it's just a sales tactic that they use to sell this nonsense.
Yeah, and that they sell a lot of this for estate planning purposes and reducing taxes after death. You know, majority of our clients don't have that issue where they won't pay estate taxes because their estate's not large enough. You know, some may have estates that, you know, we need to do some planning on to reduce the estate taxes and a tax burden there, but we're not going to use whole life to do it.
No, that one's everyone always freaks out over the estate tax, but I can tell you from like a family standpoint. I remember everyone in my family called me freaking out. My grandmother passes away. But, oh, what have we done? Are they going to look at us? And what about these gifts she's given us? We don't know if she reported them. And I sat there, I'm like, she's only got $3 million and the limit's 13.
Yeah.
They're not coming for us. Like, relax. Everybody take your money and move on with your life. But they get you on these emotional sales. Now, last one here, or maybe the last one, we might remind me if I have others. Some people do it for the long-term care benefit.
That's a popular one. So yeah, long-term care. That's insurance brokers, you know, they're going to tell you need long-term care. You need to prepare for it. We've noticed that most of our clients don't really need long-term care policy or insurance or rider on their whole life policy or rider on their term insurance policy. You know why? We're projecting them to spend more than that long-term care policy would be in retirement. And long-term care is not what long-term care used to be. Long-term care policies weren't the worst thing, 20 years ago when they first got issued. But that was because the insurance company...
That might be 30 or 40.
Yeah, 30 or 40 years ago. Because they made some bad assumptions on that when they were first doing it. They expected people to not live long, and they expected people to drop these policies, both of which were incorrect. And now these policies, instead of paying long-term care for the entire life, you probably get about $300,000 over 3 years.
Yeah, and a lot of these riders, they put you have a $200,000 long-term care benefit. Not to say that $200,000 isn't a lot of money, but if your wiggle room on you being retired or not is not bigger than $200,000, we have a much larger issue here. Mm-hmm. You are likely to run out of money. Mm-hmm. We want a much larger buffer than that. I'm not a huge fan of leaving money to kids. It's just a personal opinion. Mm-hmm. We help people do whatever they want to do, but I don't personally think it's a great thing to do. However, I tell people, look, there's no way, we have to project out market returns, assumptions, all these things, and we have to prepare for the worst. So we cannot sit here and just say, hey, you're going to spend a total of $1.7 million in retirement. So you have 1.7, that's not how it works. We have to sit there and go, okay, if things go really, really well, you could end up giving your kids a lot more than expected. If things go really poorly, they might only get a couple million, but in all likelihood, they're going to inherit about the amount of money you have when you retire in most instances. Most people, in some years the market goes down and they spend more than the earnings, but over a long period of time, most people are typically that amount isn't keeping up with inflation, so that's the only thing. But if I retire with 4, typically there's going to be 4 or 5 left in 30 or 40 years. Again, that doesn't keep up with inflation. 4 million on your retirement date and 4 to 5 million on your death date are not the same thing. However, it's still a couple million each to your kids. So, pretty good deal there. But yeah, getting $200,000 out of a whole life policy to, make sure, I've got long-term care if I need it for a little bit of time is just nonsense. You're going to pay Some of those policies, you might pay $200,000 in commissions to the selling agent.
Yeah, again, it comes down to they're salesmen. They know how to make you think you need these things. They know how to, pull on your heartstrings, make you have guilt and doubt. Um, that's how they, are so successful. And we just want to make sure you're getting the right information on it. You don't really need a lot of these things that are sold to you as necessity. Yeah.
No, so I guess to wrap up, the biggest myth here might be that you need whole life insurance, that you should buy whole life insurance. Um, don't do it. We were reading it was an investment news article you found
Yep.
about the top 40 myths, and even referenced the white coat investor that, what does this doctor know? It's
Yep.
like, well, apparently a whole lot more than the life insurance agents.
Yeah, it comes down to information, what's available to you, doing a little research on your own, not taking what the insurance agent says as the whole truth, and kind of digging into it because they're not telling you everything you need to know.
Yeah, and I think the last one, back to that tax issue, is a lot of people say, hey, once you max your 401ks and your Roth IRAs, this is the last tax deferred bucket you have. That's not true. This is not some sort of tax miracle. Don't fall for it. In general, to wrap up on what our advice would be is, hey, I don't say we like life insurance. We recommend life insurance. We recommend life insurance for when you need it. It's vitally important that you have it. However, just buy term insurance for the period that you need it, because you don't also need the same amount the whole time. When you're just buying a practice, you have a ton of debt, you have kids, your spouse might not be working. Okay, we need a lot of life insurance. However, 10 years go by, you've managed to save $1 million, you've paid off your practice loan, you've paid off half the office building. Now, all of a sudden, you might need half of that life insurance. So as time goes on, you just scale down the life insurance until you don't need it, but you buy a term, you buy it while you're young, you get it set up while it's cheap, and that way you're good to go. So buy term, and then, save into retirement plans, max all that, take the excess, put it in a brokerage account, get somebody to help you that can make it really tax efficient, because you really don't need a whole life policy to make savings tax efficient. It's actually very easy to do without any sort of fancy product.
Absolutely. Only thing I'll add in there is if you're working with someone, just make sure they're investing in those low cost fund options, because there are, even on the other end, investing in other products and your brokerage accounts. They can sell you some products that have high expense ratios and high fees on that as well. But just make sure you let them know you want the low expense options, and that'll be the best for you.
Well, I would even say if they're not offering you the low expense options or recommending to begin with, find a new one.
Again, that's unfortunate because they may not know. So you just you may just need, a consult with somebody else, a third party, to take a look at what you're investing in and see if there's any ways to improve there.
Oh, perfect. Well, Ty, thanks for joining the show. We'll be back with you next week.
Thanks for having me.